Good afternoon.
Hi, Medea.
How are you?
Good. Welcome, everyone. We'll get started here in a couple minutes. All right, welcome. We'll get started. I think we've got all that we expect to be here. Um, so it's good to, well, at least see your names on my screen today. So we've got some homework to go over and then some other things to work on. Make sure that we're all we know what's expected going forward as we're getting close to the end of the semester, term, whatever you want to call it. So um, I will share my screen for the homework. We're starting with chapter problem 26. So here is Excel spreadsheet. Now, as you uh, review what you did, obviously there are a couple of types of things that we may have done incorrectly. One of the things we may have done is type in numbers incorrectly in this information that was given because you just brought it across, and obviously there's always a ability to type that in incorrectly. And then, of course, there is the idea of actually doing that net present value calculations correctly or not. All right. So, first one, we had uh, equipment A, which cost 230,000. So we put that as a negative in the investment column or the today column or however you want to label that. All right. Our required rate of return is 10% for this, both of these A and B. And that is going to give us a salvage value of 20,000, which means that's a positive cash. That means we're going to be able to sell that equipment at the end of 5 years for $20,000. So that is a positive number. Now, if you put that in negative, and I saw a couple of as I reviewed some of the homework that had been turned in, if you put that in negative, all you need to do in your spreadsheet, hopefully, is change that to a positive, and you'll see that that makes quite a difference in this last year in terms of how much cash flow. We have our increased revenue, which was given, your utility savings. And again, you don't have to put these in any particular order. For whatever reason, I always think of revenue first and then any expenses or changes in expenses next. But there's nothing, it was given to you in a different order. And so you're certainly welcome to do that. The savings, again, it was just a matter of typing these in for each year, and then the cost of maintenance. And they actually had this maintenance increase each year. In this case, perhaps as the machine gets older, it requires more intense maintenance. So our total investment, there was no additional working capital in this problem. But I left the row there. Again, you don't need to, just so that we remember that's a possibility. But here is your cash flows for each year. 1, 2, 3, 4, 5. All right. Now, I also noted that somebody had put like this positive cash flow into year 6. Now, that's technically a little bit different than what the problem says, but not a big deal. So you'll get a slightly different answer here, but I don't think it will change your decision. That's probably a small enough difference to be not material in accounting terms, and not change our decision much in this, at least in these cases. And most of the time, if that changed your decision, you probably need to be thinking about other factors anyway. So 2 ways to do the net present value. You can come up with the factors from the table, and I copy the table right onto my spreadsheet here so we can verify 10% that the factors are 0.90909 and so forth down this column, and that I copied them correctly over to these numbers here. Then if we're doing that method, we're going to multiply and then add up and then subtract or add the negative investment. And you're going to get 6868. And if you rounded or didn't round, I'm not worried about it. Obviously, these are estimates. And so the fact that we're, literally 7,000 negative is as close as we could probably claim to be. If you do it with Excel exclusively and you don't use the factors, okay, you get 68, 67. Remember that often will be a little different based on rounding. And this was not asked for. The IRR was not asked for in the problem. But as we would expect, if it's a negative net present value, we would expect the IRR to be less than the required rate of return. And just as confirmation, just to check ourselves, we do come up with that as 8.9%, which is less than the required rate of return of 10. Questions? Anything that you can't square up with what you did? All right. Then you do the same thing a second time, but this equipment B, or however you refer to it, only costs $120,000 and is only going to provide a $15,000 positive cash flow or salvage value at the end of 4 years. Notice this is a different number of years. It's only 4 years, not 5. Increased revenue, utility savings, cost for maintenance. Again, no magic in terms of order you do that. You should get 37, 2 years, and then 39, then 56. Factors are going to be the same. because we're using the same required rate of return, at least for years 1, 2, 3, and 4. And we don't have a year 5 in this instance. You can either multiply and then add them up. All right. Subtract the investment, and you do it with the factors. You get 11,765. If you do it using the NPV formula, you actually get, in this case, exactly the same. All right. And then the IRR, again, was not asked for, but just to check ourselves, it is over the required rate of return, which is what we would expect with a positive net present value. So what would be our decision in this case? Jack, what do you think our decision is based on this analysis? What did you put down for B or whatever the requirement was? Which is preferable? Anybody else?
I picked B
Why?
because it has positive.
Okay, so remember the decision tool is if it's positive NPV, we should do it. If it's negative NPV. Now, I warned you Tuesday that we do not use net present value to compare two positive net present value projects. But in this case, you have one that's negative and one that's positive. So you can use net present value in that situation to decide that obviously the positive one is a better deal than the negative one and should be undertaken. So that can be used, but you shouldn't use it to compare two. If you have two projects with positive NPV, you shouldn't just say the one that the highest one is better. Any questions or thoughts about this problem?
I have a question. So for my NPV, I got negative 16,000.
For which
And
one?
I don't understand.
Which project?
Oh, sorry. For equipment B.
B. Okay.
Yeah. So I'm looking at like the equation that I had, and it looks exactly the same. So I'm very confused how I got that.
Okay. I think Kayla, to check year 4, did you put this 15,000 as a negative?
I did, but I changed it and all the numbers updated. So all the totals are correct and the factors are correct and everything.
And it still gets, this
Yeah,
number was
it's
still different.
Yeah, it's still 16,000 or negative 16,000.
And you have it as a formula, not as you didn't type it in or anything.
No, yeah, I have it as a formula. Oh, wait, hold on. Wait, I put in, aren't you supposed to put in the percent, comma?
The second time, yeah, if you're using the NPV,
Yeah.
0.1 or 10%, comma, and then highlight the 4 cash flow,
Yeah.
and then subtract the investment.
Yeah, I'm still getting, that's exactly what I have, and I'm still getting that. So I'm not exactly sure. I'll have to look more into it, I guess.
Yeah, that's, I mean, the only thing.
Oh, yeah.
I mean, without seeing what your formula looks like, the only thing I can, and when you go in, if you go like this, and you can see the highlighting correctly.
Yeah. Oh, I see what I did.
Okay.
I think yep, I'm good. I got it.
Oh,
thank you.
Okay. Yeah. Sometimes it's just a little thing, little tweak that it requires. Okay. I'm glad we got that. Anybody else?
I just want to make a comment. I did a couple experiments with that to see what the result would be if I changed the percentage. You can make it high low, or no percent at all, and it will still give you the identical answer. You do not need to include that 10%.
What do you mean? In net present value?
Yes, absolutely. That does not affect the answer at all.
Yes, it does.
No, it doesn't. If you use the formula and the actual formula in Excel, now I've done it. In fact, I have that answer on my spreadsheet. You can look at it because you have the spreadsheet, and I do not have a percentage in it. I wanted to see what would happen if I changed it to 9% or 11%. And I kept going up and down to see if it changed the answer, and it did not. So then I tried it without it at all,
Well,
and it did
Pamela,
not.
I'm going to change it right now. And it changes. And then I'm going to change it.
I'm
again.
talking MPV, not IRR.
No, I am in the NPV. See in the NPV? Okay. You're right. The percentage won't change IRR at all. But NPV has to change with every time you change the interest rate in the calculation, in the formula. So if I put in a different one, it will change. It is absolutely essential. Yeah, I can even make it all the way negative if I make the NPV, the percentage high enough.
So just to
You
clarify,
take a look at,
oh, sorry.
take a look at my spreadsheet then and tell me why. I use the formula bar, the Excel formula, and not typing it in the way you are.
Yep.
And it does give me the correct answer. So you might want to look at that regardless of what I did.
I will pull that, try to pull that up. Did I see another question?
Yeah, so which one did you say was the correct way or route to go then? I think I missed that part.
Which, is the decision on this
Yeah.
one? Okay.
Yeah.
So you should choose to do the one with the positive MPV, right? Which is B, the one on your right in my spreadsheet. Okay. And not do A, which because it's a negative net present value. Okay.
Okay, that makes sense.
That's
Thank you.
how you should make that decision.
Okay.
Okay. Yes, which is very important. That's I mean, remembering that rule and how to make that decision is probably equally as important, if not more important, than knowing how to do the details of this. So
I know what I did. And if you look, the instruction said to use that figure 5.2 to get that. And so the percentage was added in to the totals. So so I'm using a different format than what you have there. I'm using the exact spreadsheet that we were instructed to use. And by using that methodology, I came up with it. You take a look at my sheet and you'll see what I'm talking about.
yeah, I've got it up. All right. All right. Well, the calculation, yes. So in 26, you did it this way, which is summing up these numbers. And you're absolutely correct. If I change my, because the percentage isn't in there, it's based on these formulas. So to change your interest rate on that method, you would have to go to a different column and use different factors. So
Mm.
if you're going to change from 10 to 9%,
True.
you would, instead of 0.90909, well, whatever, it's 0.91743. It's the one just over. Okay. And you'd have to change each one of those. Okay. So that's how you change the percentage if you use the factors from the table method. I've done both of them here. Okay. And I'm looking over at your 27, and yes, over there, the changing the required rate of return will make a difference, just like what I'm showing, because you're using this net present value formula. Okay. Either way, we'll accomplish what we need to. I want you to be able to be somewhat comfortable with both, just in case. In fact, often I will do both just to check to make sure that I've done it right. Just it gives me more sense that more confidence in my answer. You do have a problem with a present value table. See, the limitation of using the table as it's shown here is, how do I do 6.5%? I have 6%, I have 7% on the table. I do not get 6.5. But in Excel, in the NPV formula, I can use any percentage I want. And so that's why there's a real limitation to using the tables, which is why we try to have two different ways, just in case we need that. All right. So we got the correct answers. We've got the decision between the two. And on to problem 27, all right, which the problem kind of said, just do it using the Excel NPV. But again, I did it in the tables as well, just to show that it works no matter the example, okay? Again, our situation is our cost of our equipment is 660, no new working capital, and that equipment will be sold at the end of year 8 for 40,000. So this is an 8-year. So this is a longer period of time than our problem 26. There was no additional revenue, just cost savings. So this was a situation where it's not that we're going to be able to generate additional sales, but just cost savings. But this machine requires maintenance, and we made that a nice, even fixed costs, the same all across all 8 years. And so instead of varying like it did in our first example, our required rate is 11 this time. So we pushed that up a little bit from last time. We got our cash flows. Okay, by taking the amount of cost savings minus our maintenance here in this row. The factors I put here, again, if you didn't do that, don't worry about it. That's just to illustrate, because it kind of pushed you to not do it that way, to use the NPV formula. So here, if you used the NPV formula, you've got the NPV 11.11, comma, okay, highlighting the cash flows across as it's shown there, and then add the negative or subtract it if you put it positive dollars, okay, and that will give you your net present value, which is 11,828. And just in case you like to feel like you do it both ways, now you have to use a different set of factors because this is 11%. So to change it to 11%, we had to go over one column in this. If we did it with our various, with the table, and notice when you look at the highlights, it's adding up these numbers after you multiply before you subtract out the investment. So in this case, we got exactly the same result, either using the tables or using the MPV formula. And the IRR is 11.4, sorry, 11.47%. So just over the required rate of return. So this
So-
is a pretty close, I would say, to zero. I mean, so you might consider other factors when making this decision, but our decision rule is positive NPV, IRR higher than 11%, then we should do it. Go ahead.
So
Pam.
try the IRR and take the percentage out. This is the formula that I do not think the percentage affects the answer.
It doesn't. You're right. Yep. You don't.
For the IRR, I only got 11% instead of 11.47.
Did you move it? Even when you allow there to be more, because this would be 11% if I round it. I mean, if I round this, it would look like 11%. Did you round?
No, I just put the formula in and that's what it gave me. I think because I rounded the numbers from the beginning.
Oh, did you?
Yeah, I round the yeah.
Are you?
Excel automatically rounded mine to 11. I had to go in and like add decimals to it.
Okay. Yeah, because it probably, if you set your formula, your overall formula to 2 decimal places, which is often what you have as a default, okay, then yes, it will tell you 11%.
Oh, yeah, I got it now.
You got it?
Yep.
Yeah. See, we're not worried about rounding errors, although, yeah, we want it to look the same. But and that's not an error. It's just the way Excel does it. Okay. But if you want it to, I just want to make sure you're getting the right answer. And if you are, that's great. But yes, remember when I taught you about see, if you look at the IRR formula, it asks for the values and it asks for a guess. And remember when I taught you this formula on Tuesday, I told you, I said, Excel still has that guess in there. That guess has no bearing, doesn't do anything in the calculation. It's not needed. You don't need to put anything in it. And it doesn't matter if you put the wrong answer or a good answer or any answer in there. It doesn't change it at all, as Pamela pointed out. So yes, that's, in fact, if I were designing Excel, I would have told them years ago to take that guess out because it just confuses people. Okay, but obviously they haven't asked me, so that's still there, but don't worry about putting anything in it. As long as you get the right values, you'll get the right answer for IRR. Okay, any other questions or things that didn't jive with what you had? All right. So we're good with that one. But yes, while there's a positive NPV that return to that, it's not, I mean, I know some of us think close to zero means like 3 or 4, but when you're talking about a piece of equipment that's going to cost over $500,000, an NPV of only 11,000, only just under 12,000 is pretty small. And therefore, you may want to consider some other things before you go forward, because that's really pretty close to zero in the overall scheme of things. Okay, so just so you get a sense of that. And again, that would depend on the company and the size of all of your other things going on in real life. All right. Problem 28. Some even bigger numbers in terms of investment, and then a couple of quirks in this problem. This time I did not copy the table or try to do it with the tables, just did it as instructed with the NPV and IRR formula. We have a -4 million, and we also have working capital in this case, which is the first one of our homework, is the working capital, 270,000. That's a negative in the current or today column, if you will, investment column, however you want to refer to that. They also threw at us the fact that there needs to be some kind of an overhaul or major expenditure in year 3. All right, in year 3. And then we have the salvage value can be sold for 400,000 at the end of year 5. Working capital gets released, as they refer to it, okay, or paid back, or however you want to look at it, as a positive in year 5. This case, we're actually doing some selling, we're actually producing a new product, and so we have additional revenue, but we have some significant costs as well that need to happen. And you notice they kept those the same for each year. So definition of a fixed cost, you might say. So revenue was the same every year, cost was the same every year. We get these cash flows. We have kind of a different cash flow for the year 5 because of all the extra things that happen. All right, we run that net present value at 20%. And notice I actually, in this formula, I reference the cell where the 20% is instead of typing in 20%, which makes it even easier to make a change if you want to. All right. So if those are the highlights, and we get this negative NPV, right? Negative 137,027 bucks. Negative 137,000. Same idea with IRR, remembering that we need to reference first in the first cell a negative number or the investment, which is always why I put the investment in as negative. So I remember to have that in this formula as a negative. And then the positive cash flows across there, and we get 18.5 roughly. Now, our decision rule on this case, okay, is that given these parameters, we would not go ahead with this project. It has a negative NPV and the IRR is less than 20%. But if you read the problem says our normal required rate of return is 15%, but that we determined that this one was high enough risk that it needed a larger required rate of return. All right. If our required rate of return had been only the 15, just for kicks, and again, this was not what you were expected to do, you would have a significantly positive NPV, you know, almost 400,000. So thinking through that kind of idea and changing that required rate of return can have a huge impact on the decision you make. And having decided that this was a high risk and adding that extra into the required rate of return made a big difference. Okay. And that's one of the benefits of referencing that in the cell, is you can just change it that quickly without having to go into the formula and retyping it in. Questions about this one? Anything that didn't jive with what you got on your spreadsheets? So big issue with determining our required rate of return. So that segues well into our discussion for this week, that for this chapter or for this module on determining the interest rate we should use for that. Required rate of return, hurdle rate, discount rate, all kinds of terms are used out there that all kind of mean the same thing. And as you saw there in that example, it is a big factor in making those decisions. So where would a company, how did the company come up with that? Again, it's a very involved process. As I say in the discussion description, I'm not expecting you to be able to calculate it. That's a much more advanced concept, but there are some simple things that that you should be able to find as just a little research as to what might go into that decision, what interest rate to use, what required rate of return. So a little research and post on that. You have till Saturday again, rather than just Thursday like we had done in earlier discussions, to do that, and then on to make your follow-up for Tuesday. So the first one by Saturday, follow-up Tuesday on that interest rate. All right. Let's see. Let's do something. Go back to our spreadsheet. So what I want to do next is I want you to consider this situation. This is the very last problem in the end of chapter exercises, having to do with ethics. So I'm going to read this, and then what I'm going to do is we're going to go into some breakout rooms, discuss, come up with the answers to 1 and 2. We're looking at what the ethical conflict is that's facing Peggy and what type of employee compensation would resolve this. So Toyota or Toyota, it's not supposed to be an actual company, produces a variety of products, including motorcycles, all-terrain vehicles, marine engines, so forth. Each division manager is paid a base salary and given an annual cash bonus if the division achieves profits of at least 10% of the assets invested in the division. Peggy is the manager of the light truck division. Considering investing in new production equipment, the net present value of this proposal is positive. All right, just as we've been learning about, they've run the net present value and it's a positive number. Peggy is convinced that new equipment will provide a competitive edge in future years. However, because of the significant upfront cost and related depreciation, short-term profits for the next 2 or 3 years will be negatively affected by this investment. In fact, such that the return on investment will go below the 10% threshold. Remember, that's the threshold over which, okay, she gets a bonus for at least 3 years, which will prevent Peggy from receiving her bonus for at least 3 years. However, profits are expected to increase significantly after that 3-year period, which is why it is a positive NPV. Peggy is planning to retire in 2 years and therefore would prefer to reject a proposal to invest in new production equipment. All right. So We're gonna automatically be assigned to a breakout room where you discuss that situation, come up with an answer as to what the dilemma is. Just take a couple of minutes and what you would recommend for a compensation that would be better. All right. Looks like everybody's back. Tanzania, can you tell us what your group came up with as what the ethical dilemma is that Peggy faces?
Hello. We were kind of unsure.
Did you have any ideas?
No, because we just wish that we could like have read the problem again more, but we were just really unsure.
Okay. Pamela, do you have anything from your group?
Oh,
about that?
yeah. We thought it was like a pretty obvious thing. She's not going to get a bonus if she does the right thing, which is recommend to do this, but it will hurt her financially. We thought she should go to a manager or somebody and tell them that they're going to recommend it, let them know how it affects her bonus, and maybe they can come up with some method to compensate her.
So when you say the right thing for whom?
The company,
Okay.
which has to be always your decision. There is, it would be very unethical to do something for your own benefit and not for the benefit of the entire company. I can't see any other option.
Okay, but we're not saying that necessarily this is going to, if she doesn't do it, it will hurt the if she says it, she recommends against it because of the positive NPV, that will be amounts that the company will miss out on long term, right?
Right.
Okay. All right. So the company will not be, so in essence, if there are shareholders, then they will be less financially ahead based on this decision?
They would have to wait a couple years as well till the shareholders started benefiting as well.
Right. Yes, and remember, and this is what makes this even harder, you might say, is all of this would have been an estimate, right? I mean, that positive NPV is not an absolute. It's not carved in stone. It's not a guarantee. And so you can, and I just want to make sure you understand that it's easier to justify sometimes when there's not a right answer, meaning there is not something you can point to in the law that says this is how we do it. We know that the decision rule is a positive NPV, we do it, but we also should understand that every one of these numbers when we're predicting the future is an estimate. And so therefore changing some estimate along the way could change the decision, and you could still be right, based on that estimate. So it makes it a little harder. Anything of Jack? Let's see, Jack, is there anything that you would say about the bonus that you might change, make this less of an issue?
See, the thing was with the bonus was that it was like reliant on the short-term profits. I would kind of make it so that maybe just for this circumstance, since she's putting herself on the line for the benefit of the company, have some sort of like even after retiring, she can get benefits if the business did well from this long-term investment.
Okay. So what you're saying in an essence, okay, is that you need the financial incentive for employees to be the same as financial incentive for the company. Meaning if the company is going to do well long-term, that employees will do well.
It shouldn't just rely on the short-term benefit of the company, but also like the long-term employees should have incentive for that as well.
Exactly. So anytime the incentives are opposed, meaning the financial incentive for the employee and the financial well-being of the company are kind of at odds, then you have a difficulty. And if you can align those so that I do well at the same time as the company does well, then you have less incentive, less pressure on employees to do something that they might find unethical. Okay.
Yeah.
The only thing I can think of that would actually help her, but it would be if they had been doing it all along. If they had been doing profit sharing by giving them shares, then she would have more incentive. If her 401k was made up of shares from the company, then she would still be profiting.
All right. Another thought you might think about is one of the things I don't like about this idea of a bonus or no bonus at one number makes it very, very, you might say, a lot of pressure to reach a single number. So, for instance, if you only base bonuses on this one number, then you're ignoring other measures of success at the company. And in Accounting 161, we actually go into a whole host of other measures of success that should be used in evaluating companies and their employees. But also the idea that maybe if you don't get 10%, what if you get 9%? Okay. Couldn't you just still get some bonus? I mean, this fact that you get 0 if it's 9.8 and you get the whole bonus if it's 10.1 is the kind of pressure that makes people willing to fudge enough to make that difference and to hesitate in these types of scenarios. And maybe she'll make the right decision as Pamela described, but why make it that much harder for her to do so? She probably wouldn't care that much if it wasn't a matter of getting all the bonus or no bonus, maybe if it was just reduced a little bit based on not meeting quite the target, if you had some kind of a gradual way. And that's a way of trying to reduce the pressure on people to make those decisions. So that's another thing to think about, is kind of a graduated reward system rather than an all or nothing. All right. Any other thoughts or questions about that kind of a decision process?
I have a question, just your perspective.
Uh-huh.
So a company I worked for a number of years gave profit sharing, and it was very, very nice. I mean, and really, we thought about everything that it would affect our bonus at the end of the year. And we got to the point where we had grown so significantly that they made a huge investment by buying a very large property, and they were going to build a new facility. But then we stopped getting any profit sharing because now we had this big debt. And that was very annoying because we were very much part of making that company grow. And I felt like we were punished for their big investment that we no longer got profit sharing. It was a little frustrating.
Well, yes, that's a very poor management strategy, because not only have you increased probably all of everybody's responsibility, then you've taken away something that they're used to and that is paid off. The whole point of profit sharing is to get employees on the same page as the company, meaning trying to think through the same way that management does. Makes everybody very interested in being successful. And to take that away, especially when you're in a situation where you're trying to expand and do new things and take on new responsibilities, is really a recipe for some not good morale. Okay. And this is exactly what we want to think about, because that's why this is called managerial accounting. And you want to think about the decisions you make with these numbers, how they're going to affect the outcomes of the company and individual employees, or as groups of employees. So yes, you need to always think about that, because I've seen that happen, something similar to what you describe in many cases. And it's sometimes that they don't realize, sometimes they just choose poorly. But that's why we keep teaching that there's something more to that than just dollars and cents. All right. So let's see, I want to go back to my spreadsheet. So what I want to do with this is just an example. It's not in your homework or anything like that. I just threw some numbers into, it looks very similar to 28, just so that the format is familiar to you. One difference that just to point out is the working capital in this case had to be spent up front, but it's not released. It doesn't come back. That's not a given. That's not always the case in real life, that the extra inventory, the extra things that we need for this situation. And this is a situation, this is robots and that we're going to install in our factory. All right. And so in this case, the working capital is not going to come back to us. But other than that, it's pretty much the same as what you're used to. Some maintenance costs, some cost savings, NPVs calculated using the formula in Excel, IRR using the formula in Excel. Okay. So what we're going to do with this is I'm going to do some polling questions. All right. where it's not going to be, you won't need to do any calculations. So I don't expect you to, go back here. But I want you to answer some theoretical questions based on this scenario. So here's our first question. RCT, which is the company that you saw on the spreadsheet, is considering the installation of robots in its factory. Using projected future cash flows, the cost to invest $5 million as shown and a required rate of return of 12%, RCT determines that NPV is 159,868, which is what is shown. What decision should RCT make? One more vote. All right. So this is the results. So those who said go ahead with robots certainly can make that case that positive NPV is right there. It's, almost $160,000 positive NPV. That from our decision rule is go ahead. All right. I'm glad nobody chose don't go ahead, because that would be the only answer that's really actually wrong. Consider qualitative factors. Yes, that's still not a huge positive number compared to $5 million of investment. And so we might want to look into other reasons to decide whether or not this was enough NPV to go ahead. And the idea of running additional scenarios is always a good idea, especially when we're trying to think about selling, spending $5 million. We would want to make sure that we considered the possibility of something unexpected happening and run that scenario to see if that would work. So hopefully you actually had some difficulty deciding between those three as to the right answer on purpose, okay? Because I wanted you to consider all of those three in this situation, but I only let you choose one anyway. So you had to finally make a decision. All right. Next one. What would happen to the NPV for the robots if RCT reduced the required rate of return to 10% and recalculated the NPV? Would it stay the same? Would it go up? Would it go down? Or I can't tell without more information. Okay, most have voted. Getting a couple more. All right. Polls are closed. Shared results. So to answer this, okay, NPV is just under 160,000 right now. I'm going to go right in here and change that from 12 to 10. And then we'll see what the right answer is. NPV went up substantially. All right. So when you reduce the required rate of return, you're going to increase the net present value. All right. So NPV would go up. All right, another change. With the 10% required rate, what if the cost of the robots ended up costing $500,000 more? So instead of 5 million, they cost 5,500,000. What should RCT's decision be? One more vote. All right, everybody has spoken. Share results. Okay, so we have a significant number of people who said run additional scenarios, which is always a good idea, right? But let's throw in that extra 500,000 into the actual dollars and see what happens. Okay. Our NPV at 10% was about 450,000, 440,000. When we go increase the cost by 500,000, that's subtracted, right? And our NPV goes to negative. So in this case, your first blush would be don't go ahead with the robots. However, with this large of an investment, that's a fairly small negative NPV. And therefore, looking at other qualitative factors and running some additional scenarios would be a good idea, especially with this size of investment. All right. But purely from this net present value perspective, and from the IRR perspective for that matter, okay, you should hesitate at least to go forward with the robots. There would need to be qualitative factors that would argue in their favor significantly, and or you need to look at other scenarios that might be considered more positive than this. All right. So with the required rate of return back at 12%, if the NPV is 0, then we know that the IRR is what? Oh, wait a minute. I should launch that first.
Yeah.
You can read it along with me. Sorry about that. With the required rate of return back at 12%, if the NPV is 0, then we know that the IRR is what? All right. Everybody's voted. Okay. Remember, the definition of IRR is the percentage at which NPV is 0. Okay. So if the required rate of return is 12% and NPV is 0, that means that IRR must also be 12%. Has to be the same. So just as an example, okay, if I change the required rate to exactly 13.21%, okay, NPV gets very close to 0. It's still 2.21% is still rounded, so it's not exactly, but it will be very close to 0 because that's the definition. So if NPV is 0, that means the required rate of return and the IRR are the same. All right. So the answer would have been 12%, right? It won't be different from the required rate of return. All right. Let me fix that back to 12%. All right, a new scenario. If RCT changes the estimate of future maintenance costs for the robots to 250,000. So right now it's 230,000. If the future maintenance cost for robots is 250,000 instead, then what would happen to the NPV on the robots? So what would happen to NPV if we increase the maintenance cost? All right. Polls are closed and share the results. Says most of you chose go down. Let's see. Okay, it was just under 160,000. If I change it to negative 250, and you see each time I make one of them go down, it makes or up, I should say, in cost, it makes NPV go down. So if I increase the costs, it makes NPV go down. If I had increased the cost savings, it would have made NPV go up. Okay. So another question. Keeping everything else the same, what would happen to NPV if the robots are estimated to last 6 years? Same cost savings instead of 5 years. So we add a year to the end. What would be the result of that? Okay, everybody's voted. Says NPV would go up is half, but there's still some other folks that disagree. So let's go ahead and put year 6 right on our and check it. So we would move this to here. Okay, we would we'd have another cash flow. And even though those, I can make it bigger so you can actually see the numbers are there. And we would come over here and have to change our formula, okay, to equal the one more year. So instead of G8, it would go up to H8. And it makes our MPV go up. Okay, so another year of cost savings. Even though the year is way out in the future and it's not as valuable of making more money next year, it is still additional amounts of profit with no change in the original cost. So if this would have been accompanied with more information, like the cost of the robots was more expensive to last those 6 years, then it would be it would have been a tougher call. Okay. But one more year of cost savings should give us a higher NPV, even if it's just a little bit on that scenario. All right. This refers back to how to use the IRR formula. When using the IRR formula in Excel, you must make sure that the first cash flow referenced in your formula is greater than 0, a negative amount, a blank cell, or next to the required rate of return. All right. So remember, look at the IRR formula here. What is the first thing it comes to in the formula? The investment amount, which needs to be a negative, needs to be a negative number below 0. Otherwise you will get num, right? Num will be the error message that you will get. So negative amount is the correct answer. And then last question, and using the tables, present value tables, for each year's cash flow, the factor for year 3 is always what when compared to year 2? Less than, more than, to the left on the table, or to the right on the table? Okay, one more vote. All right, our poll results say 50% said more than year 2. Let's look at the table. Remember, I have it over here. You pick any column of all, and the factor will be lower in year 3 than it is in year 2. So for 2% here that I'm pointing to, it's 0.96117 for year 2 and 0.94232 for year 3. That will always be the case. Moving left to right is changing the interest rate. Up and down is changing the year. And the tables always go down as the years go up. Always the factor here we're going to use. So that's one way to always be able to check your when you're putting things in your spreadsheet, you should be able to look at it and see the numbers going down across your spreadsheet. All right, any questions about those questions, I guess you should say. Okay, so here's what you have to think about over the next little bit. All right, you have the discussion post we talked about earlier. You are also working on the rough draft of break even for a restaurant. And I've already seen 2 or 3 of the submissions for that. So that's great. And I will provide the feedback before we need to do a final draft. Also, you have access to the group ethics project. You have up on this course website, the news function, everybody's been put in one of 3 groups. All the names are there, what group you're in. You have a group discussion board in week 5 where only your group can see comments back and forth. You may use that to discuss things. You may use email. You may use group text. Doesn't matter. I provide that for you to make it easy if that's how you choose to communicate. But I encourage you to get started on that. Now the reading is in the Dropbox. It's attached. Okay, it's several pages of description about the situation at WorldCom for 2 different employees who had a lot of similarities, but also some very important differences in how they reacted to the situation there. And what your job is to do is to write a paper as a group that considers the questions at the very end of that reading and answers the questions, but not in a here's the question, here's the answer format, but rather in I'm going to tell you about the situation and make sure that I cover all of those points in my my paper. All right. You do not need to provide any citations if you are referencing any information in the reading that I provided. That's understood, is that you're going to make reference to the reading you're doing. If you go outside that reading, if you do some research, and there's plenty of other sources about what happened there at WorldCom, then those would need to be cited and in a works cited at the end of your paper. Okay.
I have a question.
Sure.
The project I see under my Dropbox is not at all what you just described.
What'd you say? What's not on your?
So for my group project that I see, it tells us to do the ethical cases at the end of chapter 5, problems 53 and 54.
Oh, sorry. You're right. You're right. wrong class. Sorry, guys. Wrong class. That's my other class. All right. Too many different classes. Okay. Thank you, Jack or Nate, whoever said that. I'm glad you pointed that out. Okay. All right. Yes, we are writing answers to the questions at the end of chapter that was referenced by Jack. Yeah, the instructions are still in the Dropbox. Nix the stuff about WorldCom. Sorry about that. I explained that to my 150 class. Okay, that's the one we use there. This is in your textbook. These will be at the end of the chapter, the very past the problems we usually do as homework. Okay, we're going to look at 2 of them, and again, you probably aren't going to need any references to outside materials. You want to write that, but you want to work as a group to come up with your group determination of the answers to the questions that are proposed in those questions in that situation. Okay. So yes, you have less to do than my 150 class. Sorry about that. Go ahead, Jack.
I have a question as well. It doesn't give a like page limit or like word limit. How long do you want this to be? Or is there no restriction on that?
I'm going to let you determine that. I'm not going to. I see. We want to make sure we cover. We give a good explanation. We thought it through. I want to see that you've considered multiple alternatives. So I can't imagine that you could do it in less than a page or 2.
Yeah.
But I'm not going to say it has to be a certain length or anything like that.
Yeah. I like that mentality so much more. When I was in AP history, our teacher told us for like the big AP exam, most people write like 7 pages. And she's just like, you could write 1 page and you'll get full marks as long as you answer the question properly. So
well,
I definitely like that.
A sense in business writing, usually less words are better. So the idea that you need to get to 1,000 words or 1,500 words is really the antithesis or the opposite of what I want people to be willing to do. I want that. In business writing, we want to say everything. We don't want to leave details out. We don't want to be incomplete. We want to make our case, but we don't want to use an excess of words. And a lot of people try to use an excess of words to reach this 1,000-word magical thing so that they can count up words. And we end up with really bad writing because we put in words that shouldn't be there. So don't do that. Keep it clear, concise, but explain yourself and think through the whole scenario.
Thank you.
Sure. All right. And apologize again for the WorldCom snafu and too many jumbled things in my head. Now, as follow up on that, we will not have class in formal class next week during Thanksgiving week. Okay. We won't present the new chapter. All right. You can certainly take that opportunity to start working with your group on this assignment. Finish up the stuff from this week as well. You still ask questions on the discussion boards, all that kind of thing. But we will not have class next week. We will come back on December 1st and meet Tuesday, that Thursday, and that will be the last week of class for this short semester. Okay, before we get to the finals week. But I wanted you to understand that, and I'll try to post a reminder on the beginning of the week, next week on the board in the class, so that you'll get that reminder as well, because you might be in the habit of coming and participating in class. So that's what we have to work on. That's things to do. Any other questions?
It's getting to the time in the semester that I'm starting to think about the final. Is there a final, like our midterm? Will we have an Excel paper that we do and hand in, or is it going to be like a timed test, or what's the scenario?
It will be a timed, okay? And it will be, it will have some similar type of questions, but you will have to pick from a multiple choice or fill in the blank answer rather than submit a spreadsheet. We will do a review, and I will give you sample final exam questions the Tuesday, not the 1st of December, but the following Tuesday. That will be what we'll do for class. So that you'll have a sense of how the structure of the questions, what will look like, and that sort of thing. Anybody else have a question? All right, then hearing no other questions, if you do and you wanted to ask it in more one-on-one, please stick around, and I'll stick around as well. Otherwise, have a great weekend, and good luck with all of those things, the things that are reminded, and have a wonderful, happy Thanksgiving as well.
Thank you. You too.
Cheers.
You too.
I thought of a question. Do you want us to submit corrections if we didn't have the 2 decimal points in our problems in Excel?
Yeah, why don't you submit anyway? Just to you know, let me know that you caught that. Okay.
All right, thank you. Have a good
Sure.
weekend.
You too. Take care.
Thanks.